On Friday, the copper to gold ratio fell to a level that was equal to August of 2020. It's just barely above its 2009 lows. And that's not the only one. Interest rates, swap markets, over in China. Despite Beijing's bazooka, Chinese government bond yields are just a few basis points off of their record lows. It's everywhere. It's all over the place. But what does all that actually mean? When I say the copper to gold ratio is as bad as it was in late 2008 or early 2009, it doesn't seem to make any sense. Obviously, the economy today is nothing like it had been 16 years ago. So how can copper to gold be at the same rate now as it was back during the worst period for the world since the Great Depression, or at the same rate as the summer of 2020? It's not necessarily about what the world looks like today. And I don't mean copper to gold is saying another 2008 is right around the corner either. When you put all of these signals together, that's not what has all of these flashing such dramatic warning signs. There isn't going to be another 2008. No, the answers lie in the incredibly long shadow of 2008, as we'll see. It's the same reason why a possible recession isn't really about U.S. recession. And we got a little more data from the Chicago Fed on that today, too. What a U.S. downturn would mean for a world in which Europe is falling back further into contraction, no one believes China can turn itself around, and the last hope for staying afloat keeps sinking a little further and further into that same morass. All the while, the financial system keeps loading up on safety and liquidity, interest rates that fundamentally are going to end up going down a lot and staying there. Keep in mind, all of this is happening despite the fact there is quote-unquote stimulus everywhere. You've got Beijing's bazookas, you've got tax cuts, you've got rate cuts. Instead of asking yourself why these aren't moving markets, instead ask why there is so much quote-unquote stimulus in the first place. Maybe that's the key consistent signal. Let's start with what we got from the United States, the Chicago Fed's National Activity Index, and then we'll talk about how that fits into the context of ugly lows in copper to gold, as well as other markets like record low Chinese bond yields. What the Chicago Fed reported was the National Activity Index for the United States fell to minus 0.40 for the month of October. And that was down from minus 0.27 in September. Now, the Chicago Fed's index was originally developed to forecast inflation, believe it or not. It has 85 indicators that are separated into 4 broad categories. And when the index is at 0, that just means the economy is growing at trend. When it's negative, that simply means the economy is expected to be growing below trend or potentially in growth or contraction. So when we see an average of around minus 0.4, that suggests very strongly that the U.S. is either entering or within a recession. And they present this in units of standard deviation. So October's minus 0.40, while that doesn't suggest recession, it does indicate that over the last several months, the economy has indeed become even weaker. In fact, we've got 5 straight months of negatives for the National Activity Index. And that's with problems with the employment indicators. The group of employment indicators under employment, unemployment, and hours, they're all drawn from the establishment survey, which means they're overstating employment to begin with. So if you actually factor that into it, we're looking at a Chicago Fed National Activity Index that is getting closer and closer in the wrong direction and getting closer and closer to that recession threshold. And as it does, what it suggests is that the economy, again, confirming that it's much weaker than people anticipate, certainly the mainstream narrative of strong and resilient after a summer of concern, just an overreaction to a couple bad data points. But more than that, it confirms that outside of the employment indicators, which are worse than they appear to be, there is substantial weakness in the economy, and there was a turn toward the downside during the summertime. And it's been growing in the wrong direction, going in the wrong direction all of this time. And as I said at the beginning, recession in the U.S. is not really about recession in the U.S., what it means as far as the long-run potential. A soft landing would suggest that the U.S. economy in particular was able to escape the early 2020s, the pandemic lockdowns and everything else, the supply shock and price illusion, with little to no long-run damage. A soft landing would mean the best possible outcomes. A recession, on the other hand, especially as it emerges more completely with all of the other global indications that we're getting, instead proposes the opposite set of circumstances. that as the U.S. economy gets weaker and weaker and weaker, it means that we did suffer substantial long-run damage from the supply shock. And what we're experiencing now isn't really recession so much as the process of reconverging with fundamentals, the downside of the supply shock. And the CFNAI, the Chicago Fed's National Activity Index, fits into that in showing that we're at least experiencing the downside of supply shock and have been consistently for the last couple of years. And if it continues to move in the same direction where it gets weaker, then that would further implicate everything that I just said. But you know, instead of looking backward at the silent depression and its aftermath, on December 11th, Jim Rickards and I are going to be looking forward. We're going to be discussing what the monetary system could be, or maybe even should be. And the two of us have some different ideas about what all that means, so it should be a very interesting, engaging conversation that has to also include some thoughts about how we might actually get there, especially in the context of the downside of the supply shock. So join us on December 11th. It's a Wednesday, and there's a link in the description to sign up if you want, and I hope to see you there. At the very least, we still live in the very long shadows of that 2008 crisis, the eruption of the silent depression that was brought about by the breakdown in the Eurodollar system. But what does the copper to gold ratio, for example, what does it mean when it's at a very close to the 2008-2009 lows here in 2024? As I said, the U.S. economy, or the global economy for that matter, doesn't look anything today like it did back in December of 2008 or January, February, March of 2009. It also doesn't mean that we're expecting a 2008 repeat over the months ahead. Now, the copper to gold ratio, copper is, an industrial metal, wide applications, used in a lot of things, heavy component with China, of course, but that's the one part of it. And of course, gold on the other side, that's a financial hedge, it's a monetary hedge, it's an error hedge. So on the one side, you've got copper. When that's going up and doing well, then the copper to gold ratio is likely to be moving higher, which is a positive signal of at least reflation in the global economy. When gold is under heightened demand, it usually means not a whole lot of good things are going on. And when gold is going up faster than copper is, the copper to gold ratio goes down like we see now. That's a negative signal. But about what? That's what we need to talk about here today. And there's a correlation with interest rates as well, which is one reason why the copper to gold ratio is popular among those who talk about fixed income and bond markets and things like that. But the copper to gold ratio over the last several years diverged very noticeably from nominal interest rates like the 10-year U.S. Treasury. Right in 2022, copper to gold started to go lower while interest rates were continuing to go higher. What that was telling us is that the fundamental case for higher interest rates was, like we see in the yield curve inversion or in interest rate swaps, it was never there. The Fed was raising rates, and that's why rates went up. Not because they needed to go up or going up would do anything. What the copper to gold ratio said, along with interest rate swaps that the spreads were compressing even further, was that rates were going to eventually go back down, as we're seeing right now. While everybody over the last couple of years was convinced that rates had to go higher, these fundamental signals kept saying not only are rates going to come down, when they do go down, they're going to go down quite a bit, and they're going to stay there. Count copper to gold right in that same category, this is where the comparison really comes in. The low copper to gold rate suggests not just about interest rates, but the fundamental economic picture behind low interest rates that go down and stay there. On Friday, with gold sort of rebounding and copper remaining weak, the copper to gold ratio fell to 0.00941%. Now, it backed off today with gold being down and copper being up slightly, but that 0.00941%, that's the lowest we've seen in the ratio since August 24th of 2020. The lowest we got in the copper to gold ratio was on March 30th of 2020, amidst the lockdowns, the worst parts of the pandemic period, when it was down to 0.00832%. And the current copper to gold ratio, even today after it backed up, is lower than the 2016 lows and very close to the 2009 lows. And that's what's got everybody, I think people who are presented with this information, the comparison with copper to gold, Their immediate reaction is, okay, this got to be a false signal. There's no way that this is a key critical signal that's saying the same thing, the same level as it was at the bottom in 2009. It doesn't seem to make any sense. So we have to understand what copper to gold, like swap spreads or low interest rates, are actually telling us. How can it possibly be this low in making these comparisons with 2020 or 2009 and only 2020 and 2009 now that it's below the 2016 lows? So it's not just about recession right now, as was the case in either March of 2020 or in February 2009. It's what that recession might do, or what the current conditions are, even if it's not recession, to longer run prospects. Copper to gold in many ways is a sentiment indicator about pessimism. Rising gold, increasing pessimism. Falling copper, increasing pessimism from the real economy angle. So in 2009, obviously you had maximum pessimism. Huge demand for gold as a hedge, though gold was all over the place during the crisis. But there was also no immediate demand for copper. And that level of pessimism proved to be prescient, even though it took a few years. After 2009, after February 2009, the copper to gold ratio began to rebound as reflation set in. We did recover, or at least start to recover, from the 2008 crisis. And so the copper to gold ratio got all the way up around 0.02%, much higher than what it was at the bottom. Then in the middle of 2011, like the economy, like the eruption of the Eurodollar #2 crisis, what that suggested was that the copper to gold ratio going back down with interest rates was that global economic participants and global financial participants were becoming pessimistic all over again. So it's not just the pessimism in one particular period or another, it's the overall trend that we're interested in. What was driving pessimism in the copper to gold ratio low in 2009 was the immediate circumstances of 2009. What drove it lower again in 2011 were these circumstances of 2011, but in the context of post-2008. And what you see is that over time, the copper to gold ratio, while it rebounded initially in that reflationary period, 2010 into 2011, it's been going lower and lower and lower, almost like a stock that's on the decline. Lower highs and lower lows, as the marketplace, the entire global economy began to settle in to the silent depression. It was more about the long run potential and less about the immediate circumstances of a period like 2009. So as the copper to gold ratio trends and averages lower and lower and lower, we also see at the same time, no surprise, the global economy, not just the US, not just Europe, not just China, but the entire global economy gets further and further behind its trend. I've shown this before, the IMF data on global trade as well as global GDP, that validated this change in average, the lower averages of the copper to gold ratio, because as the copper to gold ratio goes lower, like interest rate swap spreads, we see global GDP and global trade get further and further behind its pre-crisis trend. And that makes sense. The more the world gets behind its pre-crisis trend, the more it gets further and further away from health and actual legitimate sustainable growth, the more participants in the system are going to be demanding hedges for worst case scenarios, because the further behind you get, and we're not just talking about economic terms, but social and political terms as well, the greater the chances of something big going wrong. So swap spreads and bond yields are going lower, copper to gold's going lower as the global economy gets further and further behind. So the average pessimism drastically outweighs average optimism as the copper to gold ratio over the longer run, intermediate term and longer run shifts lower and lower and lower. What the copper to gold ratio shows over the last several years of the 2020s is the downside of the supply shock, but in the context of that post-2008 paradigm, which means that we're going to get further and further off of the trend. It's not about the 2009. It's not about repeating 2009, the immediate circumstances, what drove pessimism back then. It's about this longer term realization we're going to get further and further and further and further away from trend. The lower the copper to gold ratio goes, the more certain the market is that's the case. And so that's where all the recent data and developments in markets fit in. Think about Europe. Europe was supposed to be recovering from its 2-year-long undeclared recession. 2024 is going to be the year that Europe started to go back in the right direction. Instead, over the summertime, we get more indications that Europe is falling further into recession. German bond yields, European bond yields are going lower already. The ECB, which was higher for longer at the start of this year, is now, how fast do we need to get rates to go down? Falling rates lower growth and inflation expectations, and that's just Europe. Over in China, we obviously know China's in big trouble. It's not just its real estate bubble. With no growth engine in the global economy, especially as the global economy falls off in the second half of the year, where is the growth going to be coming from in China? The bazooka is a dud. As I mentioned, Chinese bond yields are sinking all over again. Despite this, there was only ever a small increase, a little bit of a retracement in Chinese bond yields with the announcement of the PBOC's rate cuts and the stimulus, the bazooka and whatnot from Beijing in September. Bond yields only got up a little bit, and then ever since the end of September and early October, moving back lower all over again, to the point that today, China's 10-year government bond yield is just a couple basis points off of its record low. The 2-year Chinese government bond yield is back within a couple basis points of its recent low, which is very close to the record low set in 2020. So there are more comparisons with 2020 from China's perspective because the Chinese economy is moving in the wrong direction too. So you've got Europe, you've got China, we've also got the United States. We've got labor market woes here that are worse than they appear, at least according to mainstream sources. So there's a higher degree of risk, not just about, again, recession, it's about what that would mean if the labor market does continue to stumble and the rest of the economy goes with it, as we see in the Chicago Fed's National Activity Index, what that would mean for the longer run. In the context of copper to gold, it means the rest of the world, the entire global economy, continues to move in the direction of the downside of the supply shock, which means reverting to the fundamental mean. That's what copper to gold is. We're getting further and further behind from that prior trend that seems like a distant memory at this point. So obviously nothing today is like February 2009, but that's not the comparison. The comparison is what is driving the pessimism. In 2009, it was the current circumstances of early 2009. In 2024, it's living in the shadow of 2008 and realizing the chances of an actual recovery after not just 2020, but actually recovering from the 2010s continues to diminish all the time. And it's not just the one thing, and it's not just two things. There's a whole bunch of indications suggesting exactly that. I've covered interest rate swap spreads, copper to gold, Chinese government bond yields, all of these making the same comparisons. We haven't seen them this low since 2020. And before that, well, Chinese government bond yields, record lows there. Before that, 2008 and 2009. The comparison is about getting back on trend or not getting back on trend. And all the markets are saying not back on trend. Now that likely means downturns in Europe, renewed downturns in Europe, more trouble in China, and potentially, maybe even likely, US recession too. The copper to gold isn't about 2008. It's about living in the shadow of 2008 and the fact that we're still living in the shadow of 2008. Well, given all that, we have to ask, is the U.S. Treasury sell-off over with? Well, Steve and I kicked that one around in the video link below. As always, thank you very much for joining me. Huge thank you to Eurodollar University members and Eurodollar University subscribers. And until next time, take care.